Welcome to Principles of Macroeconomics. Lecture 10 will cover dynamic change in the aggregate demand aggregate supply model. Before taking a look at the aggregate supply and aggregate demand model, we should go over a few important terms for understanding economic fluctuations. The first is an anticipated change in our economic system. This is a change that is foreseen by decision makers, such as workers and businesses, in time for them to make adjustments to their long-term contracts. However, there can also be unanticipated changes. These changes include a change that decision makers could not reasonably foresee. That is, the choices they made prior to the change did not take it into account. These economic changes are important for making decisions and contracts when accounting for changes in the average level of prices in the goods and services market. But there are also necessary considerations for looking at commodities, investment, and financial contracts. In our last lecture, we briefly discussed the basics of the aggregate demand function. Recall that it is a downward sloping curve showing the relationship between total output, which is represented on the x-axis, and the average price level, which is represented by the y-axis. We discussed some factors that helped to move us along the aggregate demand curve. However, now we want to take a look at some factors that shift the entire demand curve to the left or to the right. The first factor which will influence the aggregate demand function is changes in real wealth. For example, ownership of stocks and housing constitutes a large share of the wealth of the average American. If real wealth increases, all else equal, the entire aggregate demand curve will shift to the right. If the opposite occurs, the aggregate demand curve will shift to the left. This is because it changes the amount that investors and consumers wish to buy at every price level. Therefore, we have to represent this change by a shift in the entire curve. Number two, we can have changes in the real interest rate. A fall in the real interest rate will reduce the cost of borrowing and also encourage more spending of financed items and projects. Both investment spending and consumer spending should increase at every price level, so the entire aggregate demand curve will then have to shift to the right. Number three, we can have changes in business or consumer expectations. Consumer expectations can be measured by a consumer confidence index or a consumer sentiment index. And more optimism about the future of the economy or personal finances should increase spending by both investors and consumers who anticipate conditions to be better in the future. But now we have three more factors which shift aggregate demand. Number four, we can have a change in the expected rate of inflation. That is, when consumers and investors believe that the rate of inflation will go up in the future, they have an incentive to spend more during the current period to lock in lower prices for goods and services. This expectation will stimulate current aggregate demand and shift that whole aggregate demand curve to the right. Also, we could have changes in income abroad or income in other countries. So if consumer income increases in countries that purchase U.S. exports, that is, it only needs to affect our U.S. trading partners, aggregate demand will increase as the demand for our exports increases. And remember, exports is one of our main components in the GDP calculations under the expenditure approach. And lastly, we can have changes in interest rates, or exchange rates rather. If the US dollar depreciates relative to other currencies, US consumers will demand fewer imports, but other countries will demand more US exports. These changes will cause the aggregate demand curve to shift right, as we have more demand for US products at every price level. Now that we have examined some factors which shift the aggregate demand curve left and right, we should take a look at what shifts our aggregate supply functions. First, we need to take a look at what causes shifts in long-run aggregate supply. Recall that the long-run aggregate supply function is vertical, as it represents the rate of GDP output that is sustainable. That is, we can maintain the current level of productivity into the long run. So let's take a look at some factors which shift this supply function. First, we can have changes in our resource base. If the supply of physical capital, such as machinery and factories, human capital, and natural resources increase, it will be possible for us to produce more output. This shifts the long-run aggregate supply function to the right. Also, we could have improvements in technology. So innovation and technological change can increase the productivity even if we have a fixed resource base. This causes a shift to the right of the long-run aggregate supply function. And lastly, we can have institutional changes. If we have improvements in government and public policy, such as better protection of private property rights, this can help an economic system produce more output, as it encourages businesses to invest more. However, there are two supply curves that we should be concerned with in our aggregate supply, aggregate demand model. The next we have to get to is the short-run aggregate supply curve. So let's take a look at a few of these factors. First, we can have changes in resource prices. A reduction in resource prices will tend to lower production costs, and therefore shift the short-run aggregate supply curve to the right. That is, U.S. business firms will be able to produce more at every given price level of goods and services if their resource costs are lower. Secondly, we can have changes in the expected rate of inflation. If sellers in the goods and services market expect the future rate of inflation to increase, they will be less motivated to sell their products at the current lower prices. This will tend to reduce and shift left the short-run aggregate supply function. Lastly, we can have supply shocks. These supply shocks are temporary surprise occurrences that will increase or decrease current output. Some examples could include adverse weather, which can destroy crops, natural disasters, which may destroy machinery or transportation, or a temporary rise in the price of imported resources. So we can have a price shock from foreign imported oil. This can reduce short-run aggregate supply and shift the entire curve to the left. When using this economic model, two main scenarios are possible. Number one, we can have steady economic growth and have anticipated changes in long-run aggregate supply. For example, we can have technological improvements that will shift both long-run aggregate supply and the short-run aggregate supply functions to the right to create a new long-run equilibrium. Decision makers, such as firms and consumers, will correctly anticipate these dynamic shifts. But we can also have unanticipated changes which decision makers cannot predict. But the market will tend to adjust back to the long-run equilibrium after the short-run period is over. So here are some two main unanticipated changes which we can observe using our model. A, we can have an unanticipated rightward shift of aggregate demand. This will increase output in the short run, but higher resource prices will cause the short-run aggregate supply curve to shift back to the old equilibrium output level. You can see this in the lower left-hand graph. And B, we can have supply shocks and changes in resource prices which can cause temporary shifts in short-run aggregate supply that will eventually return to long-run aggregate supply if the changes are not permanent in nature. Even though we can have unpredictable and destabilizing forces within the economy, as it is a complex organization of firms and consumers, we can observe two stabilizing market forces. First, changes in resource prices. Adjustments in resource prices will help direct an economic system back to long-run equilibrium. For example, aggregate demand may fall temporarily or shift to the left. This may cause a temporary recession, but it also puts downward pressure on resource prices. As these resource prices fall, profit margins increase because the price of goods and services is now higher relative to the cost of production. As a result, firms have an incentive to produce more output. Also, interest rates act as an automatic stabilizer. Changes in real interest rates help stabilize aggregate demand and redirect economic fluctuations. Weak aggregate demand will tend to put downward pressure on interest rates, providing a stimulus to business investment and consumer spending. Conversely, an economic boom will tend to bid up or cause an upward pressure on interest rates. This will moderate investment in consumer spending and redirect the economy back toward long-run equilibrium.